So agriculture has some very unique features. One, agricultural returns tend to be positively correlated with inflation. Again, this is Adam Smith, Ricardo, others noted that the most fixed factors of production capture the residual claims of anything when you're done paying for all the other factors, including labor. It's very true, and it's been true, and it will be true, and it'll stay very, very true for a very long period of time. So positive correlation with inflation is a really cool feature if you have something like long duration liabilities on the other side. So why should pension funds own farmland? Because it matches really well and it helps eliminate some of the exposure to shocks and inflation. Number two, interest rates. Agriculture is very underlevered. Only about 13% leverage at the long-term asset side of the balance sheet, much higher on the operating side and much higher at the short term. But the interest impact is not nearly the spread. The credit spread on farmland, for example, is very small compared to the rest of the economy. To shorten that 1 hour presentation to the most salient conclusion, what you get when you buy farmland is a very stable credit spread. So if you think of the entire world as being like a 10-year treasury rate plus spread for risk and spread for term, farmland gets a bargain on that. So that one's really important. And then income, long-term expected income is very, very positive for agriculture because of the long-term thesis for caloric demand. And the more of it we put into gas tanks, the higher the value. The more of it we put into animals, the higher the value. The more we take out of production to build houses, the higher the value. So why would an investor want a long duration, inflation protecting asset that has really good reactions to interest rates in terms of you get a little extra. Your alpha is absolutely immutably positive compared to other things. You just get a big positive alpha for a low beta. And that the long-term expectations are really strong. Well, you do, but you have to have enough of it to influence the rest of your portfolio. That's the hard thing because it turns over so slowly and in such strange chunks. You just said you'd like to buy 50 to 100 million at a time. Those don't happen all that often. They're very rare transactions. Even 50s or 20 million or 10 million or 5 million, 2 million doesn't happen that often. Farmland turns over at 1.5% to 2% a year. So it's a great thesis, but it's hard to buy. It's really hard to dispose. And we've created a factor inside the portfolio that has all these positive attributes. And by the way, most shockingly, has outperformed equities most of the entire period since the 1970s. Not necessarily NASDAQ, but a broadly held portfolio. So yes, it's a really positive portfolio asset. Really, really positive portfolio asset. Hard to buy, hard to sell, hard to manage. That's perhaps why it has generated superior returns to most other things.